Today is Saturday, December 26th, 2020, and I am your host, Max Gottlich, and we talk about my interpretations and insights into financial markets and the overall global macroeconomy. Well, it was a Merry Christmas indeed for our Bitcoin hodlers as the price of Bitcoin reaches new record highs, I think basically surging to $25,000 per Bitcoin. And of course, we know the SEC now considers Ripple a security, so why can't Bitcoin be a security too? Right, so commercial banks expect, many trillions, like $5 trillion added to central bank balance sheets, while the US 15 and 30-year mortgage rates again fall to an all-time record low of, um, of 2.19% and 2.66%, respectively speaking. And Greece has a non-performing a non-performing loan ratio of 30%. In fact, all that bad debt. And in fact, a third of the new COVID relief bill will draw $350 billion from the TGA account. We talked about what the TGA account is in a previous video, and this literally forces a setback in monetary easing and much more reliance on the fiscal side because the Fed doesn't have enough ammo for the debt ceiling, which doesn't even matter in hindsight because every time we do hit the debt ceiling, we just create a new debt ceiling and surpass it again, and that cycle repeats. And well, really, technically, it's been happening since World War I when we amended the Federal Reserve Act and we actually funded the war with treasuries. So this is why real yields on the 10-year have turned the most negative recently to -1%, which, I mean, it's approaching record lows. It looks like a form of yield curve control may be necessary if this trend continues, which I believe it will. And we know from the last video that inflation expectations are up, and I think they will continue to surge faster than nominal rates, which is supported by almost $20 trillion in negative yielding debt and increasing modern monetary policies. So governments are avoiding structural reform, which gives investors a false pretense of what kind of risk they perceive as safe when it's really not. But insolvencies will only increase as debt accumulation increases along with government debt, ultimately dragging on the real growth per usual. And we know the most crowded trades in 2020 have been, in big tech and dollar shorts with households and mutual funds and pensions and foreign investors. They own like 75% of the equity markets. So it's really it's a very concentrated minority that is getting richer, but the vast majority is not invested in financial markets. And thus they are getting poorer and the cost of living is only increasing. And there's obviously weak economic growth as debt climbs higher and higher. So the $1 trillion question, I would say, is how much longer will artificially suppressed interest rates spur the phony growth in, across financial markets? Well, today I wanted to really dive into a topic that certainly has never been discussed in business school before, because I've been to business school and they literally do not teach anything, never mind, what I talk about in this show. And this topic of discussion evolves around the conception behind survivorship bias. And so survivorship bias is best in the context during an asset bubble or market bubble or just something that's been greatly overlooked at by the vast majority, like the internet bubble or the everything bubble of 2020. And so when people discount the underperformers versus the outperformers, they completely disregard the underperformers, which will it'll exacerbate the outperformance of only those that outperform. You see, this is how bias works. And because now the average is perked higher because you're not even considering the lower decile of your sample size. And by the way, this analysis can really pertain to anything like, the performance of active funds, ETFs, equities, even metals, really anything where you can oversee and interpret historical performance data to consider an appropriate asset allocation going forward. So if you don't discount the allocation for survivorship bias, the numbers will probably definitely look better than they actually are. So it's really a type of sample selection bias when the data set only considers surviving observations, but they fail to consider observations that no longer exist. And this bias can really skew returns when talking about, right now, especially when asset classes are at all-time highs, but the underlying economic environment underlying these asset classes, it really hasn't been more worsened extremes. In other words, we are seeing the largest ever divergence between what people perceive reality to be versus what reality actually is right now. And so survivorship bias, I think, will come into a great effect when GDP forecasts are set for 2021. But there are two sides to the story, and only one of them can survive, since, as we know, the economy is a trade-off system. Okay, everyone, this is all I wanted to get into for today. Please make sure to like the video and subscribe to the channel. And also please note, I'm not a financial advisor and everything I say is for educational purposes only. All right, thank you and have a good rest of your weekend.